It's Monday, December 28th. I'm your host, Jason Moser. On this week's financial show, we're taking a look back at the year and some of the things that stood out. We're also going to take a look back at some of the bold predictions made at the beginning of the year and how that's all worked out. Joining me for our last financial show of 2020, he's my friend and yours, certified financial planner, Matt Frankel. Matt, how's it going?
Pretty good. Last week you got me and Mr. Wonderful. This week you just get me, so...
Well, I mean, I was going to say, you're our Mr. Wonderful, man. Don't sell yourself short. Well, Matt, I mentioned in the intro there, we were going to talk about some of the things that stood out here for 2020, and we're also going to take a look back at some of the bold predictions that were made at the beginning of the year, specifically by you. This is something I really enjoy being able to do with you, is looking back at the bold predictions that you lob out there for the new year, and then kind of taking a look back and seeing how that all shook out. So we'll get to that, but let's open the show here. Let's start let's start with the headline for the year. For you, when you look back at 2020 in our world of financials and all of the stuff we've covered on the show throughout the year, what's your headline for the year in the world of financials?
I'd have to say the volatility that we saw and the amount of just bargains for long-term investors.
Yeah.
Specifically during March and April, a lot of the stocks that we cover were priced like they were going to go bankrupt.
You're right. There were a lot of bargains there. That's right.
I had a portfolio, and I checked it in late March, and it looked like I owned a bunch of penny stocks. I don't know about yours, but I had quite a few in mine.
I definitely felt a little bit of pain early in the year. That's for sure.
A lot of them were priced like that, despite having really solid balance sheets and solid assets, and no real reason for the panic. I mean, just to name a couple of the ones that, just from my own portfolio, Tanger Outlets, one we've covered on the show a few times.
Oh,
yeah. Ticker symbol SKT. They had more liquidity than they have market cap at one point. I mean, and more cash in the bank than they had market cap. I mean, so that they were priced like the value of their assets were zero.
That's crazy, isn't it?
Yeah. I mean, Ryman Hospitality, the owners of the Gaylord by you, RHP. Mm-hmm. They were trading for something like $14 a share. They went into the year trading for $90. That's insane. Any one of their hotels was worth more than their market cap at that point in time.
Yeah, it was interesting to see especially early on in the year, and certainly as the year progressed. I mean, we saw a lot of those real estate investment trusts really taking it on the chin, and a lot of that was because businesses were shut down. Customers weren't going, businesses couldn't pay rent, and that rent was going to a lot of these real estate investment trusts, and it just was this chain reaction that it became very unclear exactly what the resolution would be. And I mean, obviously we saw a little bit of a lull there over the summer where business was able to pick back up, and we got some financial aid from Uncle Sam. But yeah, I mean, it's been a tricky situation for all involved, and it does feel like those stocks in that market. It feels like they were being priced for just the worst case scenario.
Yeah, there's a fine line between uncertainty and a panic.
Yeah.
And we saw a lot of panic. Like Empire State Realty is another one. I've called that the biggest no-brainer in the stock market at different points in time this year. I mean, the Empire State Building is worth about 3 times what the company was trading for, and they have a ton of other properties.
Yeah.
I mean, it's priced like nobody's going to work in an office in New York City again, which, by the way, they said right after September 11th, too, and we saw how that worked out.
Yep,
so
you're right.
It's insane how some of these companies were priced like they were going to go away. And by the way, Empire State has more than $1 billion of cash to make it through the tough time. So even if their building was vacant, I wouldn't think they were going out of business. I mean, there have just been a ton of these that's really been the story of the year to me, is just how great of an environment it's been in the financial and real estate sectors for long-term stock picking.
Yeah, I agree. That stood out to me as well. I mean, there are a lot of benefits when you go into stretches like that with a bit of a watch list and an understanding of the businesses that are on that watch list and what makes them tick, because there's a psychology to the market that it's very difficult to quantify, and the only way you can really quantify is what the stock prices are at the end of the day.
Yeah, and it's just like I said, some of the prices didn't make, like right now I say how some of the prices don't make sense in the other direction, like Tesla.
Yeah, yeah.
But in March and April, some of the prices were just like insanely cheap. They were priced like the Empire State Building was going to get demolished the next day. I mean, and it doesn't make sense. A lot of the financials, I just mentioned some real estate stocks, but like Synchrony Financial was priced like none of their credit card debt was going to get paid, none. And I mean, now it's trading for about three times what the March lows, and for good reason. It's because it was an irrational panic, and that's great if you're like Buffett says. I wish he had taken more advantage of it. But irrational panics are great if you're trying to buy stocks to hold for 20 or 30 years.
Yeah, yeah, and that's that net buyer of stocks idea that we always talk about here. I mean, when you know that you're going to be buying more than you're selling, and you're aiming to collect them and hang on to them. Hopefully, a lot of our members and our listeners were able to take advantage of that time. I know we all did to the amount that we could, but it's it's not always easy, right? It's easy kind of going in there when times are good to say, oh, I'm going to take advantage of a market when the panic hits. But then the panic hits, and you start second guessing yourself. And I think with experience, that becomes a little bit easier to do. But it does take that experience. And I go back to your mention of 2011 or of September 11th, but then also even the financial crisis back, 2008-9. Go through those periods of time as an investor, even though they're painful at the time. They really are just the most invaluable stretches where you can learn the most.
Yeah, absolutely. And I mean, this has been the first, since I've worked at the Fool, this has been the first major market turbulence that we've experienced. I wasn't with the Motley Fool in the 08-09 recession. I think you were.
No, that was right before I
you
actually
missed
got
it
here.
too.
I started in 2010. I was investing. I was a member of the Fool. I just wasn't an employee.
I was investing, and that's kind of my point. I was investing in 2008, 2009, but I was doing it in the wrong way because I didn't really get the long-term focus as much as I do now and what to look for in long-term investments. I was more like, what's going to go up the next month, or what looks like a bargain today, but I'll sell tomorrow, and things like that. And this is the first one that I really feel like for the most part I got it right, and a lot of people got it right. And from a long time, pretty much everything I bought in March and April is still in my portfolio, and I'm not planning on selling anytime soon. And I'm pretty sure that you've said the same.
Oh yeah, yep. I subscribe to that as well. What's one stock? What's one business stock or business? Let's combine the two. But what's one of the business performances out there that surprised you the most over this past year? Given the pandemic and everything that's gone on, there are a lot of surprises, both good and bad. What's one that really stood out to you? And you can go either way, good or bad.
Well, let me give you two. I'll give you one each way.
All right.
One that really negatively surprised me was Howard Hughes Corporation. I know
Oh,
I
yeah.
talked about them. They were just poorly prepared for this.
Yeah.
To be fair, their three biggest markets are Las Vegas, which got absolutely hammered. I mean, Las Vegas is still really suffering. Houston, which is really tied to the oil industry. We know how that's doing this year. And New York City, which they own the Seaport District. So they got hit harder than most. But the fact that they had to do a dilutive equity raise at about 70% less than the stock was before the pandemic.
Ugh,
And
that's
you know
just
who
brutal.
bought most of the newly issued shares?
Who?
The company's chairman, Bill Ackman.
Oh, wow. I didn't realize that.
So it really sounds like, to me, it felt like kind of a sneaky way for Ackman to buy more of the company. Because they sold it to him for $50 a share. Howard Hughes started the year at 130-ish. So the fact that they had to do that to raise capital, they didn't have a credit line, they didn't have cash in the bank, anything like that. It's kind of a similar situation to how we say the airlines, all they've done is buy back stock. They haven't put anything in the bank. It kind of feels like they were just really poorly prepared for it.
Yep. Well, I think a lot of folks were. What about the upside? What company, you said you had two, what company surprised you in the good way?
It's not a financial, but FedEx.
Ooh.
They had a
Yeah.
fantastic year. The stock's up about 75% year to date for good reason. They invested a lot in recent years in their infrastructure. You remember they've kind of had like a war with Amazon going on.
Oh yeah.
They appear to be winning it. I mean, Amazon's not using them anymore. So what did I love this move that FedEx just recently announced. They announced that they're acquiring a e-commerce platform called ShopRunner,
Oh wow, I
which
didn't
is
realize that.
which is essentially an Amazon Prime competitor. They have a network of companies. They have Under Armour's on there, American Eagle's on there, the NBA stores on there, and it's like a 2 day shipping if you join ShopRunner. It's like an Amazon Prime. You could buy from any of them with free 2 day shipping, and I love that move. They're a big recipient. They're a big beneficiary of the e-commerce boom, and the fact that the postal service is so backed up. I'm still getting Christmas cards that were they were
So
mailed like 3 weeks ago.
so are we.
And
So are we.
they're a big beneficiary of that because when you have an efficient shipping service like that, it's tremendous pricing power when the alternative takes a month.
Oh, there's no question. Yeah, that's interesting. And that ship runner, that sounds a lot like the business that Target acquired a little while back, Shipped, which is essentially, it sounds like the same thing. I mean, it's that same type of Amazon Prime competitor where it's able to not only really serve Target's purposes, but also they're able to bring retailers from all different walks onto that platform as well to give them more of an e-commerce presence and give Amazon a little bit of competition. It seems like it's really, at the end of the day, it's working out really well for investors and consumers.
It is. I mean, I added a lot to my FedEx investment in 2019. I mentioned it on the show after I did, and I'm really glad I had a feeling that they weren't just going to kind of go quietly after Amazon stopped using them.
No,
A company like
no.
that, and it's paid off.
Yeah, that's a good move. That's a good move. I like that. Who would you say? Now, there are a lot of different ways you can go with this because a lot of leaders really did stand out in 2020. But who are you calling out as your best CEO of 2020?
I have a few. I have a few honorable mentions because my number one is not the financial sector, so I want to give you a few honorable mentions. One is David Solomon from Goldman Sachs. I think he's done a great job of growing the consumer banking capabilities of that company even during the pandemic. Another is Willie Walker from Walker and Dunlop,
Oh yeah.
who they met their 5 year goals in 2020 that they set 5 years ago despite the pandemic. And he kind of like, I don't know if you saw their recent investor day. He put out a presentation where they basically want to dominate consumer real estate or commercial real estate finance in the next 5 years.
That's a big
I mean,
market.
and right now they're just a multifamily lender, so that's a pretty I love the ambition. But my number one for the year has to be Bob Chapek of Disney.
Ah, yeah.
Um, and I kind of I'd say Bob Iger, who was CEO until February, is also worthy of the title. I don't want to call them co-CEOs during the pandemic. But yeah, late February 2020 is not a great time to be taking over as CEO of anything.
No.
I love that he did right by his employees for the most part. He held off on layoffs as long as possible. I mean, we just learned of a big round of layoffs in November just because they can't get that California park open. But they kept their employees on payroll for a lot longer than a lot of other people did. The streaming success has just been off the charts.
Yeah.
Um,
Yeah, it really has.
they hit their 5 year goal within a year. They now see up to 260 million Disney Plus subscribers by 2024. That would make it bigger than Netflix in the U.S.
Yeah, yeah. I mean, that's granted it's a projection, and that's what they're aiming for. But when you see the additional markets that they're rolling out, I mean, everywhere from Latin America to Eastern Europe, I mean,
Right.
it does feel like they're getting out into markets there where people will really be clamoring for that Disney brand.
And they have the competitive advantage that they're doing this. I mean, there's some original content like The Mandalorian, things like that. They're doing this. A lot of it's with content that they already owned. They don't have to develop as much new content as say Netflix does. I mean, we pay for Disney Plus so my daughter can watch Frozen 7 times a day. Not 7 times. I'd say 7 times a week. But you know what I mean. And that's not costing Disney a dime. So this has the potential. I mean, right now they're investing heavily in content, but this is the potential to be in the tens of billions of dollars a year in high margin revenue
Oh yeah,
over
yeah,
time.
no doubt
So I
about
mean,
it.
I love that how they've just like they're a stock that should have been crushed. I mean, they have a cruise line that's not sailing. They have theme parks that weren't open and are still at, I think, 35% capacity. They have movie franchises that have no theaters to show in. They should have been crushed this year, but they're not. And it's, I mean, their management team, you really have to take your hat off to them.
Yeah, yeah, I agree. I agree. They've done a stellar job, and you're right. That was a very difficult time for him to take over the position, but he's made that his company, and I tell you, he's done one heck of a job with it. Listen, Matt. In order to be a good investor, we need to be humble, right? We need a little humility. We need
Who,
to
me?
understand that. Yeah, well, we all do. We all. No one's perfect, right? We make mistakes. We get things wrong. What was something that you got wrong in 2020 that stood out to you?
The magnitude of the COVID pandemic, hands down. I was one of the people in January, February saying, "Yeah, it's just the flu. It's just the flu. It'll never turn out to anything here. It'll get." I mean, not that I quote the president very often, but when he said like it'll get warm and go away, I was kind of in that camp for a while in the early part of the year. I had no idea how bad it could get. It caused me to make some investments way too early in February, when the market started to drop because we heard about the outbreak in China. There were a few. I think it started in the Seattle area was where we first got it in the U.S. If I'm
Yeah,
remembering correctly.
sounds right.
So there were some fears. There weren't very many on U.S. shores. So I made two investments that I really remember that were way too early. I bought Occidental Petroleum the day before the market crashed, which was, that's you
Yeah.
don't get much worse timing than that. And
Yeah.
Goldman Sachs as well. I bought both of those in February just because I thought it was just an overreaction about nothing. And that obviously turned out not to be the case. I quickly changed my tune as soon as, the actual spread and the actual outbreak started. It was clear that I was wrong. And I wasn't the only one who was saying it's just the flu,
No,
to
no,
be,
no.
to be fair.
Hey, listen, I'll jump on that. I'll jump on that. I underestimated it as well. I think we all, hey, listen, I was speaking with physicians early on in the year that felt the same way. I mean, this was something that most people underestimated, and folks who don't cop to that, I think, are just fooling themselves and not being fully honest.
And we have some of our colleagues who admittedly got it right.
Yeah.
Brian Stoffel's one that I know was on Twitter in February saying, "Let's shut everything down now. It's going to get bad." And I was like, "You're crazy." And it turns out, that tweet didn't age well that I responded to him. So I mean, we had some people who got it right. I wasn't one of them. I thought it was a lot of fear mongering going on at the time. I regret feeling like that now, but I think I made up for it. I think I got it right in the long run.
Yeah, yeah. Well, I think a lot of us underestimated it, but hopefully we're turning the corner into a better and more productive year here. Final look back here to 2020 here. What was the biggest thing? One of the biggest things that 2020 taught you as an investor?
That there's no such thing as a recession-proof stock. Um, Before 2020, if you had told me that any recession would cause Realty Income, ticker symbol O, to lose half of its value, I would have said you're crazy. Or Disney, like we just mentioned. If you told me Disney would be trading for half of what it started 2020 at some point, I would have thought you were crazy. These are recession-proof companies in my mind. But the big lesson to learn from 2020 is that every recession is different. Every recession affects certain areas of the market in different ways. We clearly haven't had a pandemic like this for 100 years. And the last time we did, things like fintech didn't exist. So
Yeah.
you can't assume that just because something is recession resistant, that it's recession proof. And that's what really the lesson I really learned. Like banks, my portfolio is banks and real estate. That sounds like a pretty recession proof portfolio. Not so much this year. In March, all you guys at the Fool with all your Zooms and all your DocuSigns and all that were laughing at me in March and April for having all my real estate and all that.
Well, I don't think anybody. Well, I know I wasn't laughing. I think I've learned enough lessons through the years to try to keep that dose of humility. But I mean, to your point, I mean, the financial sector really hasn't fully recovered yet either. I mean, I was looking at this earlier today, actually, the S&P 500 Financials Index, right? I mean, I think it's 65 of the most relevant financials. And I mean, I'm talking about banks and insurance companies, right? There aren't any payments companies in this index, but that index is still down about 6% for the year and underperforming most everything else out there. So it has been a very tough year for banks. And you're right. I mean, for an industry that is viewed as fairly defensive even in the toughest of times. It has not fared as well. But the flip side of that is I think actually we could be looking at a pretty good setup for a lot of these financials going into 2021, assuming that the vaccines take hold, and assuming that we do see some economic recovery.
Yeah, I mean, I'd agree with that. But when I think to the three recessions that have happened in my adult lifetime have been to this year's the COVID recession. We've had the 2008 2009 financial crisis and the dot-com bubble bursting in the early 2000s.
Yeah.
All three of those affected the market in very different ways. In 2000, 2001, stocks like Zoom and DocuSign would have gotten clobbered.
Sure.
And I mean, and in this recession, they went through the roof. So every recession is different, and that's a really important lesson to learn. A lot of people generalize what would happen in a recession. And generally, there are some, constants. You get lower interest rates during recessions, for example, for the most part. I mean, the Fed generally cuts interest rates when a recession hits. But when it comes to individual stocks, every recession is its own animal, and that's a really important lesson to learn. I found myself learning the hard way this year.
Well, Matt, back in December of 2019, December 9th, to be specific, you published an article on Fool.com called 5 Bold Predictions for the Stock Market in 2020. Now, you do this, I think, every year. You publish these predictions. It's fun. I mean, you go into it you take it all with a grain of salt. It's fun. It gets you thinking a little bit outside the box, and we always have fun previewing them. And then, like we're getting ready to do here, we're going to review these 5 bold predictions that you laid out for us back in December of 2019 to kind of see how everything has worked out. Now, clearly, when you wrote this article, there was really no anticipation that we would be running into the pandemic. But, I mean, the lesson there is that you can't ever really predict the future, right? I mean, you just got to go with whatever you're brought. So let's go ahead and jump into this, because I want to take these one at a time and cover each 5 of them here and just give you a chance to revisit. And we'll go ahead and start with number 1. And this first bold prediction, I think, is interesting because it kind of came to fruition, but then it also kind of didn't. And I'm going to let you explain.
Yeah, number 1, I said the stock market will have a rough year. And I think mid-year, I think that was very accurate.
It still feels like it's been kind of a rough year.
It's been a rough year, as in I feel like 2020 has been going on since I was 10 years old. But it's been an interesting year, and that was a very bold prediction at the beginning of 2020. I mean, for the most part, the market had been going straight up for a decade, and everybody was predicting the same in 2020. They were predicting that the biggest catalysts were Donald Trump was saying tax reform 2.0. Remember that? Mm-hmm. That was supposed to happen during 2020, which for obvious reasons got put on the back burner as the year went on. But there was really no reason in most people's mind to think that the market was going to have a tough year. But in my mind, like you said, I had no crystal ball that predicted the pandemic. I would have rather been wrong in the pandemic not happen.
Oh yeah.
But my point was just that there was a lot more that could go wrong than right at that point. There was the trade war that was still going on. There was, interest rates were kind of heading downwards, which is usually indicative of a recession. The yield curve had just inverted, to be specific. But there was just a lot more that looked like it was going to go wrong than right. And I mean, like I said, that's one of them I'm not happy I got right.
Yeah. Yeah. Well, hey, listen, you can only do what you can only do, right? Okay, let's look here at number 2. And this involves a certain, I guess, octogenarian still, and may or may not have involved an elephant gun. I don't know. What happened here?
Well, number 2 was Warren Buffett will make his biggest acquisition yet. And I'm going to tell you a secret, Jason. If I put this on the bold prediction list every year, I'm going to be right eventually.
Eventually you will.
Or Buffett's just going to have like $500 billion to work with at some point. And he'll just, he'll buy Apple or something like that.
Well, I guess he didn't really make a big deal this year, did he?
No, it really disappointed people, including me in March and April when we when we found out that he literally did almost nothing in the second quarter when the market crashed. The biggest move he made was selling his airline stocks at big losses. Then, toward the second half of the year, he looked like he was finally putting some money to work. He bought some more Bank of America stock. He acquired Dominion's natural gas assets. But he didn't make any big acquisitions, and he didn't fire the elephant gun like he likes to say. You said you couldn't remember his big acquisitions this year. It's because he didn't make any. His biggest acquisition recently is still Precision Castparts, which was 2015. So I'd like to think I'm leaving this off the list. I just wrote my 2021 piece. I'm leaving this off the list for next year. Watch, now it's actually going to happen.
That's the way it usually works.
He still has a ton of cash and supposedly wants to make a big deal, but valuations have just been a big obstacle. And now that the market's at all-time highs again, I don't see how that's going to change.
Well, number 3 is a subject that I feel like you and I talk a lot about this. We've talked about it, I think, I feel like we talk about it every year, but we talk about it probably every month. But it's just in regard to the financial sector in general, right? And more acquisitions, perhaps, that could be on the way.
Yeah, 2019 was a pretty big year for acquisitions in the financial sector. BB&T and SunTrust, that's when that merger happened. TD Ameritrade and Schwab, that's when that was announced. So I predicted a lot more of that in 2020. Obviously, the pandemic got in the way of that somewhat because the financial sector was a little hard hit. We still saw some. E-Trade was acquired by Morgan Stanley. That was probably the biggest financial deal of the year. There were a few smaller ones, but I'd have to mark that one half right.
Well, half's better than none. What about number 4? Because this kind of goes in tandem with number 1 here. But I guess technically you did get this one right, I think, yeah?
I did. It says the U.S. economy will fall into recession, which did happen. And to my knowledge, we're not out of a recession yet.
Well, I guess we got to wait till we see the numbers. But yeah, it's. I think you're right. It's still going on.
And I mean, I'll defend myself a little bit and say here's one. My first line under that was here's one that I hope I'm wrong about. But I listed a few reasons there. It's that economic growth has noticeably softened, which was true. That the Fed had started to lower interest rates before the pandemic. The trade war wasn't showing signs of progress. There was just a big standoff going on between the U.S. and China.
Yeah.
Election risk was definitely a thing. Before the pandemic, I would have viewed a Democrat win as a negative for the market. And it generally is when you go from a Republican-controlled government to a Democrat one. It's usually a negative reaction at first. Prospect of higher taxes, more business regulation, things like that, without a pandemic going on. So that kind of threw a wrench in that. And like I mentioned earlier, the yield curve had just inverted during 2019. So that's usually a pretty reliable predictor of a recession. So I actually don't know how bold that prediction was, just because it's a pretty reliable indicator. But like I cited a statistic there in December 19, Bloomberg put the chance of a recession in 2020 at 26%, and they were wrong.
Wow. Holy cow.
Most other prediction models I saw were in that neighborhood. So that's what made that a bold prediction, is that pretty much everyone was calling for just business as usual in 2020.
And you remember those good old days where the headlines were just dominated by China trade tensions, the whole relationship there, trade disputes with China. I mean, that was like, that seems so tame now.
Yeah, it seems like such a non-issue
right?
at this point.
I know. I want to get back to those days. Let's get back to those days, Matt. Hopefully 2021 will take us back to those days. Well, number 5 here, another interesting one. And hey, listen, I can tell you, I know this worked out because I think a lot of people refinance their homes throughout the year. But lead us into number 5 here.
Yeah, I'd actually be curious to hear from anyone listening who hasn't refinanced their mortgage and why. Number 5 was that interest rates will fall. So I've like I said, this kind of goes along with the prediction of a recession and a rough year for the markets. Those usually come with interest rate cuts. But I also said that mortgage rates and all consumer interest rates would get really low. I didn't go so far as to predict negative interest rates. which didn't happen, but we're certainly talked about it at certain points throughout the year.
Well, they've happened elsewhere around the world. They just haven't really happened
So they
here.
just haven't happened here. So we have record low mortgage rates right now. Federal funds rates at 0 and probably will be for a while. If you have a credit card, your credit card interest rate is usually linked to the federal funds rate. So that's, lower than it started this year. If you're borrowing money or, buying something big, 2020 is, I'm not saying to spend beyond your means, but 2020 is a good time to be borrowing money if that's what you need to do.
Yeah.
I've refinanced. I know someone who's refinanced twice. Because the rates went down to about 3% and then they went down to about 2.5%, and it was worth doing it again.
The numbers don't lie. That is one of those things where you can just look at the numbers and they make sense and okay, well, let's do it again. It's a hassle, but still, at the end of the day, it's saving money.
I'm not going to lie. I've looked into refinancing again because the rates have dropped since I did it in June.
I know. It's been amazing.
I got quoted a 30-year mortgage at 2.3%.
Wow.
That's
just
pretty
tremendous.
Crazy.
Yeah, it really is. And you figure they've got nowhere to go but up from here, but we've been saying that for the past several years, so it's going to be fascinating to see how that interest rate environment plays out here over the coming year.
Well, once it hit 3%, I told my wife, it's not getting any lower. We need to refinance, and I was wrong.
Well, hey, timing is everything, like they say. Well, Matt, that is an excellent review of your bold predictions for 2020. I appreciate you digging into that for us. And listeners, you can rest assured that we will be digging into Matt's bold predictions for 2021 here on an up-and-coming episode of Industry Focus. So don't worry, we'll be digging into those. We'll have a lot of fun with that. But Matt, I think that's going to do it for us this week. We've been together at this show now. We've been doing this show for better part of 2 years now together, and I hope it just goes without saying that I really enjoy and appreciate getting to do these shows with you. So thanks for another great year, and I'm really looking forward to 2021.
Absolutely, I hope it's a less eventful year in 2021, but that we had some good shows.
Yes, sir, we did. And remember, folks, you can always reach out to us on Twitter at MF Industry Focus, or you can drop us an email at industryfocus@fool.com. As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. Thanks, as always, to Tim Sparks for putting together the show for us. For Matt Frankel, I'm Jason Moser. Thanks for listening, and we'll see you next year.